Hi, everyone, and welcome to our VoiceThread presentation. We're excited to walk you through a topic that's both timely and highly relevant in a world of supply chain management, Nike's Footwear Inventory Challenge. Our team, MNG24, which is myself, Nick, Audrey, and Trevor, we chose Nike as our company because it's such a recognizable global brand. And yet, even a company of its scale and success can face serious supply chain hurdles. Now, I'm going to go ahead and jump into the overview on the next slide. To give some structure to our presentation, we'll begin by looking at Nike as a company, its position in the athletic wear industry, and the mission, vision, and values that drive its global operations. From there, we'll dig into the specific operational issue, the possibility that Nike is overstocking, particularly in its footwear division. We'll examine what that means for the company's supply chain performance and financial impact. Finally, will present a solution based on optimizing Nike's economic order quantity. Through analysis and comparison, we'll show how a more strategic EOQ approach could help Nike manage inventory more efficiently and cut down on unnecessary costs. When we think of global athletic brands, Nike is almost always at the top of the list. With its iconic swoosh and deep cultural influence, Nike has built a massive operation that reaches consumers around the world. To better understand the challenges it faces, it's important to first look at how the company operates and what drives its strategy on a global scale. Nike operates in the apparel, accessories, sports, and equipment industry, but it's so much more than just a product company. At its core, Nike is driven by a mission to bring inspiration and innovation to every athlete in the world. The belief that if you have a body, you're an athlete. Its vision focuses on expanding human potential, and that shows in everything from its product design to its marketing. The values Nike stands by, like innovation, authenticity, and inclusiveness, are central to how the brand connects with consumers and drives its global success. Next, we look at Nike's supply chain. It's massive and highly complex, with a clear upstream and downstream flow. Upstream, they rely on third-party manufacturers like, well, excuse me while I butcher these names, Poshin, PT Pan Brothers, Flugent Sun International, Delta Galil, and Eagle Nice to produce the bulk of their footwear and apparel. These partners handle sourcing, production capacity, and scheduling, so Nike doesn't own the factories but manages the relationships and logistics. Downstream, Nike distributes its product through Nike Direct, which includes wholesale and retail operations, along with partners with nearly every major athletic footwear realtor worldwide. This setup gives Nike global reach and flexibility, but it also adds layers of complexity that can lead to inefficiencies, especially when it comes to inventory management, which we'll explore next. When it comes to Nike's position in the market, a SWOT analysis gives us a clear snapshot of where the company stands, starting with strengths. Nike's brand is globally iconic. Its reach, innovation, and marketing power keep it ahead of the curve in many ways, but it's not without weaknesses. The company still heavily relies on third-party manufacturers, which can limit flexibility. Plus, its premium pricing and past ethical controversies can affect public perception. On the opportunity side, Nike is well positioned to grow through e-commerce, sustainable product lines, and tech innovations, especially with things like data-driven personalization. And finally, the threats. Nike faces constant pressure from strong competitors, ongoing supply chain disruptions, and the growing issue of counterfeit products that can undercut both brand value and customer trust. It's important to step back and look at the big picture, specifically the external forces shaping Nike's strategy. That's where a pestle analysis comes in. Politically, trade policies and tariffs can raise costs, especially since Nike relies on overseas manufacturing. Economically, rising supply chains, expenses, and inflation add pressure to the bottom line. Socially, shifting consumer preferences, like the growing demand for ethical and sustainable products, are pushing Nike to evolve how and what it produces. On the tech side, advancements in automation offer Nike an opportunity to streamline operations and reduce dependency on manual labor. Legally, protecting intellectual property is an ongoing challenge, especially with the rise of counterfeit products. And environmentally, climate change continues to disrupt global supply chains, whether through extreme weather events or changing regulations. All of these factors impact Nike's ability to stay competitive, especially when it comes to manufacturing inventory efficiently. Which brings us to the core issue we'll focus on next. I'm going to pass it on to my friend and colleague to continue from here.
Thanks for that overview, Kyle, into Nike. This is Audrey, and now that we've looked at the company and the broader landscape, let's shift our focus a little bit to the key issue that we're exploring in this presentation, and that is Nike's inventory levels. And specifically, we're asking, are they overstocking? And if so, what impact is that having on their operations and bottom line? In their 10K for 2024, Nike reported their footwear division generating around $33.4 billion in revenue. If we estimate the average selling price of a pair of Nike shoes to be right around $110, that means Nike is moving roughly 304 million pairs of shoes per year. That is a lot. But here's where it gets interesting. Based on Nike's cost of goods sold and average inventory, the company's inventory turnover rate sits at around 3.57. And that translates to holding about 3 months or roughly 102 days of inventory at any given time. For a company operating at this scale, that slower turnover rate suggests that Nike may be producing and holding more inventory than it can sell efficiently. In a fast moving market, that can quickly lead down to markdowns, excess storage costs, and even product obsolescence. So, as you can see, this isn't just speculation. It made headlines. These are just a few examples of recent news stories highlighting Nike's inventory issues. From markdowns and deep discounts to stock price dips, tied directly to inventory concerns, it's clear the company has been feeling just a little bit of pressure. In 2022 and 2023, especially, Nike found itself carrying more product than it could sell at full price. And as these articles briefly show, that excess didn't just affect warehouses, it had ripple effects across financial performance and investors' confidence. So, why is overstocking such a big deal? You might say, well, Audrey, isn't it better to have more than you need than not have enough? And well, in any other scenario, yes, you're right, that might be true. However, in this case, it ties up capital and warehouse space. That means higher storage costs and less flexibility to respond to new trends or shift inventory where it's actually needed. And second, footwear trends tend to shift pretty fast. If you have any sort of social media presence, you know this. And if Nike's sitting on too much unsold stock, there's a higher risk that those products become outdated. And that leads to markdowns, which chip away at profit margins. And in some cases, the inventory might never sell at all. And we saw this play out in recent years, where excess inventory led to deep discounts across Nike's product lines. The longer those shoes sit in storage, the more they cost and the less they're worth. Now, avoiding overstocking is incredibly difficult because finding the right balance between supply and demand means managing a whole bunch of moving parts. On the supply side, Nike deals with challenges like shipping delays, labor costs, tariffs, and the limitations that come with using third party manufacturers. On the demand side, things like fashion trends, seasonal shifts, competitor pricing, and even brand perception can change very quickly. With so many variables at play, even small disruptions can throw off planning and lead to mismatched inventory levels. So it's a constant balancing act and not an easy one to get right.
Thank you for that insight, Audrey. My name is Trevor, and I will be covering our optimal inventory solution with the focus on the Air Force One sneaker. Now that we've broken down the challenges, let's shift to the solution. To help Nike manage its inventory more efficiently and avoid overstocking, we're proposing an optimized approach based on economic order quantity, or EOQ. Let's take a look at how this model, alongside several other factors, can make a real impact. Up until now, we've been looking at the big picture of Nike's inventory challenges. But to really understand the impact, let's narrow it down to a specific product. We chose the Air Force One because it's Nike's top selling shoe, making up nearly 43% of all footwear shipments in North America. That's over 130 million pairs a year, bringing in about $14.4 billion annually. With numbers this large, even small inefficiencies in how inventory is managed can lead to a significant financial waste. That's why we picked the Air Force One specifically as an ideal case to test how optimized inventory model like EOQ can make a real difference. This is where our solution comes in. Based on Nike's production volume for the Air Force One, about 130.6 million pairs a year, we calculated an optimal economic order quantity, or EOQ, of 22,361 pairs per order. This order size leads to about 447 orders annually at $500 per order. Nike's total ordering cost would come to roughly $223,000. On the holding side, the EOQ results in an average inventory level of 11,180 pairs. With the holding cost of $20 per unit, that's another $223,000, bringing the total annual inventory cost to about $447,000. What's important here is balance. The EOQ gives Nike a sweet spot between how often they place orders and how much inventory they have sitting in storage. It reduces the risk of overstocking while still ensuring they can meet demand. And as we'll show next, this model doesn't just improve efficiency, it also saves money when compared to a larger, less optimized order size. Now I'm going to go into the total Air Force One inventory cost and savings using EOQ. Using our EOQ model, the total inventory cost for the Air Force One line in North America would come out to about $447,000 annually. That includes both ordering and holding costs using our optimized order size of 22,361 pairs. Now, when we compare this to a larger, less efficient order quantity, like 35,000 pairs per order, we found that Nike's total cost would actually rise to around $492,857. So just by switching to this EOQ model, Nike could save roughly $45,645 per year on just one product line in one region. And when you consider that the Air Force One is sold globally, those savings can scale quickly. Now I am going to pass it on to my colleague Nick to go over the global effect and other data-driven approaches.
Thank you, Trevor, for that great insight. Hi, everyone. My name is Nick Barbato, and I'll be walking you through how our EOQ model can have a significant impact when scaled globally. Let's take the Air Force One, for example. If Nike applied our EOQ model across major regions like Europe, Greater China, South America, and the Asia Pacific, the total annual savings could reach approximately $180,000 per year. Now, that's just one sneaker model. Nike currently sells over 420 different footwear styles worldwide. If a similar EOQ strategy were implemented across its broader footwear portfolio, the potential cost savings could add up to millions annually. This highlights a key takeaway. A simple shift in ordering strategy, when scaled, can drive massive improvements in global inventory efficiency and profitability. Now, of course, EOQ is a powerful tool, but it's just one part of the bigger picture. There are several other data driven strategies that Nike can use to refine inventory management even further. First, machine learning based predictive analytics can help Nike better anticipate demand by analyzing past sales, seasonality, and external market factors. Next, real time sales data can enable faster decision making, allowing Nike to quickly adjust production and distribution when unexpected trends emerge. A just in time model could also help Nike align production more closely with actual demand. This would reduce excess stock and lower holding costs. And finally, strengthening relationships with third party manufacturers can provide greater flexibility, reduce lead times, and support smaller, more frequent order batches. So, what happens when we bring all of these elements together? By applying our EOQ model alongside predictive analytics, real time sales tracking, a just in time approach, and improved supplier coordination, Nike can create a truly optimized inventory management system. For instance, EOQ helps strike the right balance between ordering and holding costs, but when combined with these additional strategies, the impact is even greater. This would offer Nike the precision, flexibility, and efficiency needed to stay competitive in a constantly evolving market. And with that, we hope our presentation provided a clear look at the power of data driven inventory management and how the right strategies can generate real value for a global brand like Nike. Thank you all for your time today. On behalf of the entire MNG 24 team,